Welcome to StockTok's deep dive into Bank of Montreal. Bank of Montreal is Canada's oldest bank, providing personal and commercial banking, wealth management, and investment services to customers across North America. As of May 1st, the stock is trading at $152.49. Over the past 52 weeks, the stock has ranged from $97 on the low end to $154.48 on the high end, placing the current price near the upper band of recent trading. The 14-day Relative Strength Index, a momentum oscillator that measures the speed and magnitude of recent price changes, sits at 66.2, suggesting neutral momentum. The 50-day moving average stands at $142.17, while the 200-day moving average rests at $129.67. The stock has traded up fractionally over this period. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Bank of Montreal generates revenue through net interest income, that is, the spread between what it pays depositors and charges borrowers, plus fee income from advisory services, trading, and wealth management. The bank operates in a highly regulated environment where scale and brand reputation create a durable moat. The StockTok score on this name is 35 out of 100, signaling caution. Breaking that down, valuation scores 7 out of 20, financial health scores 7 out of 20, profitability scores 10 out of 20, growth scores 9 out of 20, and smart money sentiment scores 2 out of 20. Now valuation. The question every investor has to answer: are you paying the right price? Bank of Montreal trades at a price-to-earnings ratio, or PE, of 17.6 times trailing 12-month earnings. The forward PE, that is, the multiple based on consensus earnings estimates for the next 12 months, is 14.59 times, suggesting modest compression ahead if estimates hold. The PEG ratio, which divides the PE by expected earnings growth and helps identify whether a multiple is stretched relative to growth prospects, stands at 1.86. That reading sits slightly above 1, indicating the market is pricing in reasonable but not exceptional growth relative to valuation. The enterprise value to EBITDA multiple, or EV/EBITDA, which compares the firm's total economic value to its operating earnings before interest, taxes, depreciation, and amortization, shows 0.00. The price-to-sales ratio, comparing market capitalization to annual revenues, is 4.08 times. Our DCF model, a discounted cash flow valuation that projects future cash and adjusts them to present value, suggests the stock is trading at a 29.02% premium to intrinsic value. That margin of safety is negative, meaning the market is pricing an upside that may not materialize. Wall Street analysts maintain a consensus mean price target of $143, with estimates ranging from a low of $128 to a high of $157 from 3 covering analysts. That suggests the market may offer limited upside from current levels. Regarding the economic moat, Bank of Montreal benefits from regulatory barriers to entry and the stickiness of deposit relationships, though competitive intensity in Canadian banking is significant. Market sentiment around Bank of Montreal leans bullish, reflecting broad positive momentum in financial equities. In Q2 of 2025, Bank of Montreal reported earnings per share, of $2.62, beating analyst consensus estimates of $2.55 by 7 cents. Revenue came in at $9.8 billion against consensus estimates of $33.48 billion. That revenue miss warrants scrutiny. The significant gap suggests either analyst estimates were severely inflated or reporting methodology differs from consensus expectations. Net income for the quarter reached $2.49 billion, and revenue grew 5.8% year-over-year. The stock fell 0.5% in after-hours trading following the announcement, a muted reaction that suggests the market had largely digested the results beforehand. From a valuation standpoint, the setup looks moderately stretched to us. Moving to financial strength. How solid is the foundation? The Piotroski F-score is a 9-point checklist that evaluates balance sheet health, operational efficiency, and capital allocation. Bank of Montreal's F-score of 6 out of 9 suggests a moderately healthy balance sheet with some yellow flags. The Altman Z score, a bankruptcy risk model developed by Edward Altman that combines 5 weighted ratios, registers at 0.00 for Bank of Montreal. That 0 reading indicates the model cannot compute a traditional distress score for a bank, as banks have fundamentally different capital structures than industrial companies. This metric is less useful for financial institutions, so we focus on traditional bank metrics instead. Cash to debt, which measures liquidity relative to leverage, stands at 0.26. That ratio is low, indicating the bank holds roughly $1 of liquid cash for every $4 of debt obligations. For a bank, this is typical. Banks do not maintain high ratios of cash to debt the way industrial corporations do, because deposits function as their funding source. Interest coverage, which measures the ability to service debt from operating earnings, shows not available, or NA, suggesting the metric is not calculated for banks using standard formulas. The current ratio, a near-term liquidity metric comparing current assets to current liabilities, shows 0.00, again reflecting the unique accounting structure of banking entities. Debt to equity stands at 3.21, meaning the bank finances $3.21 of assets with debt for every dollar financed by equity. For a bank, a 3.2 to 1 leverage ratio is conservative relative to industry peers, which often operate at 4 to 1 or higher. The balance sheet appears adequately capitalized, though the low cash-to-debt ratio warrants monitoring in a rising rate environment. Next up, profitability. Is this business actually making money efficiently? Return on invested capital, or return on invested capital, a measure of how much profit the firm generates from every dollar of capital deployed, shows 0.00. As with the Z-score and current ratio, this metric cannot be calculated for banks using standard industrial formulas, because banking profitability depends on the spread between asset yields and funding costs rather than invested capital in the traditional sense. Gross margin, the percentage of revenue remaining after direct costs, shows 0.00 for the same reason. Banks do not report cost of goods sold the way product companies do. Operating margin and similar metrics are also 0.00. Instead, we focus on net margin, which measures bottom-line profitability. Bank of Montreal's net margin stands at 24.71%, meaning the bank converts just under 1/4 of every revenue dollar into net income. That is a healthy margin and reflects the capital-light nature of financial services. Free cash flow margin, the percentage of revenue converted into cash that can be returned to shareholders or reinvested, is 14.48%. That indicates the bank generates meaningful free cash flow despite the capital requirements of a regulated lender. Return on equity, or ROE, stands at 10.45%. That metric measures how much profit the bank generates from every dollar of shareholder capital, and 10.45% is respectable though not exceptional for a large, diversified bank. Return on assets, or ROA, is 0.62%, indicating the bank deploys its asset base with modest efficiency. The most recent quarter's net margin of 24.71% reflects stable profitability, though the revenue miss suggests operating leverage may be constrained. Overall, profitability is solid but not expanding. On to growth. Is this business expanding, and at what rate? Over the trailing 3 years, Bank of Montreal has grown revenue at an annual rate of 11.2%. That pace reflects both organic growth in lending and deposits as well as any acquisitions completed during the period. Over the past 5 years, revenue growth has moderated to 4.4% annually, signaling a deceleration in the growth trajectory. That slowdown is consistent with a mature financial institution operating in a developed market where customer acquisition costs are rising and competitive pressures limit pricing power. Book value, which represents the equity value per share on the balance sheet, has grown at 6.5% over 3 years. That growth lags the 3-year revenue expansion, suggesting the bank has not converted top-line growth into equivalent shareholder value accumulation, possibly due to share repurchases or capital returns outpacing earnings growth. The most recent quarter showed revenue growth of 5.8% year-over-year, decelerating from the 3-year average and suggesting the bank may be facing cyclical headwinds or market saturation. Dividend yield, the annual dividend payment divided by stock price, stands at 3.13%. For a financial services company of Bank of Montreal's scale, a 3% plus yield is attractive and reflects both the market's caution on growth and the bank's commitment to capital returns. The dividend is also typically well covered by earnings, providing downside protection. The setup here is a mature, slow growth business. Expansion in single-digit percentage terms with attractive income, but limited capital appreciation. Now let's talk smart money. What institutional capital is actually doing with this name. 6 top-tier investment gurus currently hold Bank of Montreal in their portfolios, according to Dataroma, which aggregates holdings from legendary value investors and hedge fund managers. That level of guru ownership signals some institutional confidence, though it is not overwhelming. Among the 13F filing base, a universe of roughly 3,000 institutional investors that file quarterly position reports with the SEC and other regulators, only 3.1% are net buyers of the stock, meaning they increased their positions in the most recent filing period. That is a very low percentage. When net buying reaches 50% or higher, it signals broad institutional appetite. 3.1% indicates institutional investors are largely indifferent or net sellers. Insider ownership, the percentage of shares held by company executives and board members, stands at 0.00%. That is quite low and suggests management has minimal personal capital at stake in the business. Typically, meaningful insider ownership, say 5% or higher, signals confidence in management's view of value. 0% ownership raises questions about management's conviction. Over the past 3 months, we have seen 0 insider buys and 0 insider sells. No activity whatsoever. That suggests either management believes the stock is fairly valued, lacks conviction about near-term direction, or is restricted by trading windows. Mares and Power Funds, one of the top holders, carries Bank of Montreal at 0.01% of their portfolio and has made no change to that position in recent filings. That tiny position sizing, despite being labeled a top holder, indicates even Guru Capital sees this as a minor position within their broader strategies. The smart money signal here is decidedly cautious. Institutional buying is weak, insiders are inactive, and even prominent holders treat this as a marginal position. And finally, the verdict. Let's bring it all together. On valuation, the stock trades at a moderate 17.6 times earnings with a negative margin of safety, suggesting current prices are at or above fair value in our view. On financial strength, the balance sheet is adequate for a bank, with a conservative 3.2 to 1 debt-to-equity ratio, though liquidity metrics warrant monitoring. On profitability, the business generates a healthy 24.71% net margin and 10.45% return on equity, though returns are not expanding. On growth, the company is expanding revenue at single-digit rates with a deceleration trend visible over 5 years, paired with a 3.13% dividend yield that provides income but limited capital appreciation. On smart money, institutional buying is weak at 3.1% net buyers. Insider ownership is 0%, and even top holders treat this as a marginal position. The most recent quarter delivered an earnings per share beat of 7 cents, but also a significant revenue miss that raises questions about the sustainability of near-term guidance. Earnings are expected to grow to $3.41 per share in the next reported quarter. Consensus estimates range from $3.27 to $3.53, providing a near-term catalyst. Overall, Bank of Montreal presents as a mature, modestly valued bank with stable profitability and attractive income, but deteriorating growth momentum and weak institutional support suggest caution. The setup warrants waiting for either a more attractive entry point or clearer evidence of an inflection in growth trajectory. In our view, everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Bank of Montreal. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.